Hey, with markets with May. And today we're going to be talking about FedEx, which reported yesterday to kind of a rough quarter. It's been dancing down in the aftermarket as low as down 5%, but it actually came all the way back up to flat during the middle of today. And I don't know which way this thing is going to go, but I do want to talk about the quarter because even though I would say this is not a good quarter, but there were some things in it that were interesting. Regardless, it is probably one of the best examples to demonstrate what I have been on about aggressively on Twitter, and that is that there is a massive stimulus package that has happened to all corporations that is largely speaking ignored by the markets right now, other than you're seeing this massive market rally. So I think this piece of macro is missed by most people in the weirdest possible way. And I'm going to show it really clearly in FedEx. And then over the course of this next earnings season, I'm going to demonstrate it very clearly as each company puts out its 10K, as each company reports its quarter and starts to show these line items that seem a bit of a mystery. And again, the thing that I'm talking about is the fact that most large cap companies have, in fact, termed out their debt at a much lower interest rate. And now we've got interest rates well over that, meaning that even if they just hold it as cash, they're going to make, quite a lot as a base return above and beyond. And this has not happened since the 70s. So most people that usually would have thought in this process are dead. That's why it's not being talked about a lot in the news, because that particular cohort of people that used to invest in equities is dead. And now we're going to bring it back because everything is a little bit retro. Okay, before we get into today's earnings report, disclosures, past performance not indicative of future returns. I am not telling you to buy or sell anything. I actually have no position in FedEx because it doesn't quite meet my investment criteria. That said, it is really easy and clean on the numbers to show you what it is I'm talking about that exists for all of large cap. Okay, so let's just go briefly into the quarter. Here's the deal. This is revenue down 10%, but you had this crazy kicker on earnings year over year. Okay, now when you listen to a lot of folks online talk about earnings, most of their stuff is coming through a data feed. And I listen to a couple of the other YouTubers and FinTwits talk about FedEx and estimates relative and all that stuff. And I'm like, not one of you understands what this company actually does. Okay, number one, we care about FedEx because FedEx is the first each quarter within logistics to tell us what happened and what they saw in the previous quarter. These numbers close out and book out May 31st. This is the first data point in June that we have for what happened post Silicon Valley Bank. And down 10% is actually better than I would have anticipated, because you got to think Silicon Valley Bank happened in the middle of March and the banks closed down for business. So this tells you what companies were able to do despite the banks being more or less not giving you any kind of meaningful financing terms. And it really does support this thesis that the companies are flush with capital. They have enough cash to go. And most people that are reading their data off of a data feed and not really appreciating what the numbers mean are going to get this wrong, just flat out wrong. So revenue down 10%. Yes, there were lower shipments made. And also, by the way, realize that this headwind exists, which is the inventory issue that we've been working through since the fourth quarter of last year. So despite those two things, down 10 for FedEx is good, quite frankly, because remember, last year they still had the roll off of some of the Amazon contracts that they still had that now UPS has the lion's share of, as all of, quite frankly. Okay. Margins down 22%. There's nuance here that's kind of important. Part of that nuance is that it's all coming from express and freight. Okay. The express side, that's to be expected given all the tightening that's been happening globally. The freight side actually is a bit more interesting because we know that eventually the freight that's come in that is caused the inventory issue because all of it came delayed in the third and fourth quarter. Eventually that's going to normalize out. And so this freight down 26% because it is still the cheapest way to ship stuff. That's going to normalize out. That's the kicker that people are looking for the upside on if they're in it now. Like I said, am not in it now. It's a little bit too rich for my blood, but it doesn't mean that this was, the signs of a turn are in fact happening. Net income up 176%. Let's talk about this because this actually gives you insight across all companies and is really important. If you look at this line item right here as to where it's coming from, other retirement plans, if it's a negative, it's an expense. If it's a positive, it's income. They took a 750 mil income on it versus last year they took a 1.1 billion downside to it on the mark. And you have to remember, this is May of last year. And this is all like the pension fund money is mostly going to be fixed income related, as well as whatever it is that the auditors are requiring that you put in cash money more. Raising interest rates has actually helped this. It helped this part of all businesses that have a pension expense associated with it, to the extent that, number one, they don't have to take marks, and number two, every time the bonds that they have rolls off, they get to reinvest whatever's left into something else with a significantly higher rate. And also, the auditors are going to see that a particular way. Okay. And then the other thing that you kind of want to keep in mind is that most of the corporations, unlike government pension, are actually full up. In other words, they funded them really well, knowing that the auditors were requiring them to fund when rates were at 2%. Okay, rates now are not at 2%. And in fact, the yield they can get off that rate is pretty good. So we're not going to have pension liability being the same issue that it's been for the last since 2008, right? So this is a big deal. And we're seeing it really clearly on FedEx's income balance sheet, et cetera. Okay, next little piece that I want to show you, the ground segment. This is where you see glimmers of hope for the economy at large. It's kind of a big deal. Volume improved and margins improved. Okay, here's the deal. Margins improving is 100% a rarity in ground in particular. That is the CapEx that they've been doing, not just to buy, electric vehicles, but also to just do logistics better, which is, where is the package? Where is it actually on the way there? What value and how do I load them into a given vehicle so I can get more in the vehicle? Okay, so that was a really big deal that you're seeing improved operating margins. And while it may not seem like much, because quite frankly, this is part of the reason why I don't necessarily go all in on logistics, because the operating margins relative to other businesses are just really thin. But you're still seeing it's now at 2.1% on the quarter, realizing that all of last year, if you do trailing 12 months, it's 1.4. So we're seeing this ramp up from 8% up to 10% on the ground business, which by and large is going to continue to grow. Now, a couple things just on the ground business to keep in mind. Purchase transportation, what is that? That's when they outsource. So they were able to outsource less, which overall is bad for some of the smaller guys, realizing that some of FedEx's outsource is their international business, which they're still trying to grow out. Like some of the CapEx is on the international side as they try to grow that business, because other countries don't necessarily have the economy of scale that we have in the United States to try to ship packages. So that's kind of a big deal. All right. Volumes improving, but still down. So improving is good because it really demonstrates the difference. Here's the thing. Some of this is coming from the fact that the economy is slowing down because everybody across the globe is tightening. Some of this is them getting inflation through, but volume cannot be inflation related. Volume has to be people are starting to buy again. A huge component of why people stopped buying in the third and fourth quarter was because stuff came off boats late. And so people had a bunch of inventory late. So now we're starting to get the dynamic of what's actually happening. And what this suggests is, in fact, that some of that inventory coming off late is starting to work its way through the system, and there's a new demand for purchase. So this is a good thing on the quarter. All right, what else we got here that's kind of relevant? It's really the debt stuff. I want to kind of get to that. A few more things you can see here very cleanly. The revenue per package, that's increasing rates on packages. It's really the overnight has more or less stayed the same because that business isn't doing as well. But, other stuff, which is more freight and stuff like that, and then international priority continues to be weak on pricing because they just need to fill the boat. Okay, now let's talk about cash flow, because I noticed some people that are doing financial news are looking at cash flow and they're like, the free cash flow is weak, la la la. And free cash flow is one of the most important things because it is what allows you to do CapEx, buyback stock, et cetera, or a growth CapEx. In this case, CapEx was down a lot on the quarter. Okay, so some of that is they had a bunch of CapEx they did, and now they have less CapEx. And this has been a 10-year, I mean, this has been a very long process, realizing that this company has so much history. It used to, really benefit from Amazon, but UPS, Fair and Square ripped that contract out from underneath them. They had to recast their business model the last year and a half, 2 years. Okay, so some of that CapEx decline, really, really great. But fair and square, it is down year over year. And on a free cash flow basis, for me personally, I do think it's a little bit pricey as well. But just wanted to kind of show that there's still $2 billion worth of extra cash that's being thrown off this company, even though just like every other company that has strong consumer, and product to it, so to speak, the fourth quarter is really the quarter where FedEx makes its money. The most important thing, though, is not free cash flow right now. It's the debt. Okay. Here's the thing. I want to show you guys this. A lot of folks got upset with them because they're like, I don't understand why they are like buying back stock, and why all the use of money for buying back stock. Actually, notice that there's no real new debt issuance on this whatsoever. Okay. And some people are reading this like, hey, that means that, hey, Grandpa Barry, that means that, they're just doing something, they shouldn't be allowed to buy back stock, whatever it is, and they should use it to pay down debt. I'm going to tell you now, I don't want them ever touching this debt until we get some other regime within economics, because this is their debt. Okay. As you can see, this debt is mostly, if you look down across the numbers, this debt is sub 5%. Almost all of it. This is the debt that's due in this decade. Quite frankly, it's not that much debt. The company has about, makes about is cash flowing $2 billion a quarter. So they don't need to pay down this 3% debt when rates are at 5%. All they have to do is take that debt, this 1 billion, and leave it as cash and let it get a 5% money market rate. And they make money just off the cash. And everybody is doing it. This started to be announced fairly aggressively. I started to see it in the last month, that the results of having termed out debt and then money market accounts just skyrocketing as a function of what's happened with Silicon Valley Bank. I started to hear it in every single company that reported in the month of May instead of in the month of April. Okay. So I don't want them touching their debt. I don't care what anyone else says. That would be a dumb move when this is your interest rate. Okay. And if the Fed continues to raise, all that's going to happen is that more and more, they're just going to make cash off the fact that their debt is termed out so far into the future. Okay. So let's take another closer look at that. I mean, look, they've got almost $1 billion termed at less than 2% on this particular piece. Don't touch it, is what I have to say. Okay. So let me show you what this is in the 10K. You guys can see this. Oh, wait, I don't think I put it on here. You'll see about $20 billion if you add. Okay. So most of this debt, very little of it is due at all in the near term. And so that is about all I have for this particular video. We'll keep it kind of short, but hopefully you can see why I'm not yet fully bullish, because I need to see if the banks are going to be crippled in some crazy way, but I'm not bearish. I'm not bearish because if the Fed stays the same or raises rates, it means that there's this massive stimulus that some of the companies have already. As it stands, there is this massive stimulus that's happened because the CDs that people are rolling their money market accounts into are at 5% and change. I don't really see any other stuff going on in the chat today, so I'll keep it short. Grandpa Barney, thank you. I always appreciate you so much. Popular loner, you crack me up, but I'm glad that you watch my videos, so no shade. And that'll be that. Yeah, exactly, Grandpa. And that is it for me today. Have an awesome day. Bye, guys.